Hello everyone, my name is Hitesh and I welcome you all to YouTube channel of Trade Brains. If you haven't yet subscribed, please click on the subscribe button and get regular notification on the fresh content which is published by us. Now the topic of discussion today is the one upon which the whole base of the options trading is based, and I'm going to talk about the topic of intrinsic value and time value. Time value is also known as the extrinsic value because it's an external factor which has an impact on the pricing of an option. Now, before discussing about the concept of intrinsic value, let us understand what exactly is the definition of intrinsic value. So, in case of an option, the intrinsic value of both call option and put option is the difference between the underlying stock price and the strike price. In case of both call option and put option, if the value of calculation for intrinsic value is negative, it is assumed to be zero. Now the definition might sound a bit long and confusing. I'll tell you in simple terms. In simple terms, basically the intrinsic value tells you what is the worth of the strike price which you have chosen right now if I were to exit that strike price immediately. If the worth of the strike price is positive, then the option is said to be in the money. If the worth of the strike price is zero, then the option is considered to be at the money. But if the worth of the strike price is negative, then the option is said to be out of money. But we have to understand that the intrinsic value can never be negative, so it is even assumed to be zero even when the intrinsic value is negative. So intrinsic value for at the money option and out of the money option is zero, and the intrinsic value for in the money option is always positive. So that is the simple definition of intrinsic value. Now you might be asking me, what is the extrinsic value? Extrinsic value are those values which has an impact on the pricing of an option. Sometimes what happens, you might see that I have bought an out of money option, but the premium which I paid for that out of money option is say 10 rupees. Now the argument which could come is that how come I am paying a premium of 10 rupees when the intrinsic value or the current exercisable value of that option is zero? The 10 rupees which you are paying is the extrinsic value or time value of the option. Because the option has still time to expiry, there are chances that the option might expire in the money. So which is why you pay a certain price to buy out of money option and you cover the time factor into it. I'll be explaining about all this detail when we take live example. These are the theoretical aspect of the intrinsic value and extrinsic value. Now before dwelling more deeper into these concepts, let us understand what is the concept of option premium. To put it in simple words, option premium is the price or a fees or a commission which I pay to buy the right on underlying asset to be bought or sold upon expiry. And the option premium is a factor of two components. One is the intrinsic value, basically the current price of the option, and the time factor. And just to put things into perspective, the value of the time factor is the highest when it is very far away from expiry, and it comes and shrinks down to almost zero on the day of expiry. So more the time to expiry, more expensive the options are, and as we get closer to expiry, the option pricing becomes near the intrinsic value of an option. These are simple aspects of option premium. Now let us take a simple demo and understand how do we calculate the intrinsic value, what is intrinsic value, and what is the time factor. Now if you look at my screen, I have got the option chain for ICICI Bank. If you see on the screen, the current price of ICICI Bank is 709 rupees, which is I have marked on the screen. And as you go near the at the money expiries, that is 710 rupees strike price, 720 rupees strike price, 700 strike price, we'll try and understand what is the premium and what is the factor of intrinsic value and the time value. If you look at the 710 strike price, which is at the money strike price because it is closest to the spot price of underlying asset, the call option premium is 18 rupees 80 paisa and the put option premium is 16 rupees 95 paisa. If you look at 720 strike price, the call option premium is 14.55 and the put option premium is 22.75. Similarly, for a 700 strike price, the call option premium is 24 rupees 10 paisa and the put option premium is 12 rupees 15 paisa. Now let us try and break down what is the difference in the intrinsic value and the extrinsic value in these three strike prices. Now if you take at the 710 strike price, as you remember, the spot price of ICICI Bank is 709 rupees and a 710 rupees strike price has a premium of 18 rupees, which means 710 rupees at the money call option is paying a premium of 18 rupees. Why is it paying so? Because there is still 15 days to expiry and we are charging 18 rupees over and above the intrinsic value just to cover the time factor. So which is where time factor plays a major role. Similarly, in case of a 710 put option, The premium which is charged is 16 rupees 95 paisa. But again, the intrinsic value of that option is 1 rupee, Why are we paying 16 rupees? Because that 14 or 15 rupees extra which we are paying is to cover the time factor cost, because there's still 15 days left to expiry. So which is where extrinsic value and intrinsic value both become a part of the option premium. And if you go a little say deep down the curve, a 740 call option has a premium of 8 rupees 10 paisa. But the intrinsic value is 0 because the strike price is above the spot price, and as we know, out of money option have a 0 intrinsic value as we discussed earlier in this video. So 8 rupees 10 paisa which we are paying to buy that particular option is the extrinsic value cost or the time factor cost which we are paying to buy that particular option. So in the pricing of an option, time factor becomes the most critical factor and the most influencing factor. Now let us understand that at what level of moneyness, that is in the money, at the money, out of money, is the premium the highest. Let us take the demo from this example only. A 690 rupees call option has a premium of 30 rupees. And what is the spot price? 709 rupees. The premium which we are paying is 30 rupees, which means 19 rupees is the intrinsic value and 11 rupees is the time factor value. That is 19 plus 11 is 30. For a 710 rupees call option, the premium which I am paying is 18 rupees 80 paisa. The intrinsic value is 1 rupee, which means the time value or the extrinsic value is 17 rupees 18 paisa. For a 730 rupees call option, the intrinsic value is 0, but the premium which I am paying is 11 rupees 10 paisa, which means that 11 rupees 10 paisa is the time cost. So from all these three calculations, the highest amount of extrinsic value goes to the at the money option, and which is what is followed in any underlying asset you take. At the money option has the highest extrinsic value because it is closest to the current price of the underlying asset. So I hope this simple illustration of the concept of intrinsic value and extrinsic value, which is the time factor, gave you a decent understanding on this important concept which become an integral part of option trading. If you have any more questions, comment or queries regarding these two topics, put everything in the comment section. I'll be more than glad to answer this. And I thank you for your patient hearing. I'll again see you in next videos of financial education. Thank you so much.